Welcome to Making Sense, an investor education program of the Burlington County Library. I'm Carol Glade, a financial educator. Putting money away for retirement is an important step to financial security. It's important to understand how tax-deferred investments can help you have adequate funds during this time of life. Managing money will always have its challenges. By understanding how tax-deferred investments work and how you will access these investments in the future, you can avoid penalties and you can make sound financial choices and decisions. Most people invest to achieve long-term financial goals, such as funding for a young child's education, to increase current income, to build wealth over time, or financial security in retirement and for peace of mind. People may also choose investments to provide a stream of income, typically in retirement. Investing helps build wealth over time, and there are many types of investments to select from. Some people prepare very well for retirement, while others do not. This chart represents the average sources of retirement income. While many people rely a great deal on Social Security to cover their retirement expenses, Social Security should only be one part of your asset development plan. Putting some money into taxable and tax-deferred investments will help you create a more diversified portfolio. Tax-deferred investments are those where taxes on investment earnings are postponed until a later date, typically at retirement. The higher bars in this chart represent the higher amount earned on tax-deferred investments when taxes don't have to be paid each year. By deferring taxes, your money has time to grow before you take it out. When you withdraw the money, you will pay taxes. It's very important to understand the difference between tax-exempt and tax-deferred investments. Being tax-exempt means that taxes are never owed on the investment's earnings. An example of a tax-exempt investment is municipal bonds. The income from these investments is free of federal tax as well as state and local taxes if the investor lives in the state that insured the bond. Another example is Series EE and I U.S. savings bonds, which are exempt from state and local taxes. Most tax-deferred investments are designed to help people save for retirement. Money is invested in a tax-deferred plan and taxes are postponed until the investment is sold or earnings are withdrawn. Essentially, you don't pay taxes on the earnings until you decide to withdraw the money. Many retirement accounts, such as IRAs and 401ks, are tax-deferred investments. Many employers offer tax-deferred salary reduction plans, such as a 401k, a 403b, or a 457. These are types of tax-deferred accounts used to save money for retirement. Workers elect to reduce their salary by a certain amount each year. The amount of the salary reduction is deposited into the plan. These employee contributions are tax-deferred. Some employers match a portion of what the employee has contributed, and every dollar matched is considered a 100% return on the dollar deposited. The funds in these types of accounts are invested in stocks, bonds, mutual funds, and other investment options offered by the plan. The employee will make the determination based on his or her risk tolerance and investing goals. There are many types of individual retirement accounts, or IRAs. The regular or traditional IRA is tax-deferred. The amount a person can deposit each year is limited, and the person must have earned income. Each owner selects the IRA investments, and the interest earned is accumulated tax-deferred until the money is withdrawn. There are withdrawal limitations on IRAs. A person may begin withdrawing funds from an IRA at age 59 and a half. A person must start taking withdrawals at age 70 and a half or pay a penalty. Because the withdrawals are considered taxable income, the owner will pay taxes when the funds are withdrawn. A working spouse may also open an IRA for a non-working spouse to help build funds for retirement. Roth IRAs have the same annual contribution limits as regular IRAs, and for both types of IRAs, workers must select their own investment products. Roth IRA contributions are made with after-tax dollars, or money that has already been taxed, and withdrawals are tax-free if requirements are met. Determining when to withdraw funds from any IRA may seem confusing. Just remember that IRAs are intended for retirement, so you must begin taking the funds out at some point in time. This is called the required beginning date. The required beginning date, or RBD, is the date when someone is required to start taking mandatory withdrawals and paying taxes at ordinary income tax rates on this money. The key age to remember for RMDs is 70 and a half. For example, if you turned 70 on May 1st, 2012, you turned 70 and a half 6 months later on November 1st and would need to make your first RMD withdrawal by April 1st of 2013. An exception is the qualified plan of someone's current employer if they are still working in their 70s or beyond. This is called the still working exception. The still working exemption only applies to a worker's current employer's retirement savings plan, such as a 403B. However, it does not apply to IRAs or any tax-deferred plans from previous employers. The required minimum distribution, or the amount you must take, is based on simple math. You can take your RMDs at any time during the year, and multiple payouts are fine as long as the minimum amount is withdrawn. Retirees can make their RMDs withdrawals at any way they want, as long as they take out at least the minimum that is legally required each year. As you save and invest money for retirement, or use the money while you are retired, beware of fraud. Retirees are prime targets for frauds because they are easier to reach than other age groups, because they have greater wealth in general than younger people. Scam artists also prey on older persons' fears of running out of money, particularly when interest rates available on cash assets are low. Major red flags for fraud are high guaranteed returns, especially on unfamiliar investment products, and limited time offers that rush people to make investment decisions. AARP conducted a study in 2010 and found that certain activities put age 50-plus consumers at greater risk of becoming fraud victims. These activities include attending free lunch seminars, entering drawings to win a free prize, or allowing salespeople into your home uninvited. Almost 2/3 of older fraud victims participated in at least 2 of these activities. Anyone can become a victim of fraud. Fraud is a crime, and it results in the loss of billions of dollars each year. Good retirement plans take into account a variety of individual factors such as health and employment status. Early saving and tax-deferred investments will increase accumulated retirement savings, and Social Security was never meant to be a sole source of retirement income, although it is for many people. Understand how tax laws dictate savings, deposit limits, and minimum required withdrawals on tax-deferred and tax-exempt investments. Learning more about saving, investing, and planning for retirement is always important. By selecting the right investments for you, you can make your money grow and become a savvy investor. Thanks for joining me today. More information on this and other money managed topics is available through the Burlington County Library at their Making Sense website. Visit or contact the Burlington County Library for more information. This program was brought to you by the Burlington County Library with funding from the American Library Association and the FINRA Investor Education Foundation. Thank you for attending.